Good morning, good afternoon, good evening, since we have participants logging in from different time zones. Welcome to Simon Quick Takes. This is where we bring together some of the insights from the Dean's Corner blog for you in a quick Q&A and webinar fashion. What I'm going to talk about today is what currency crisis can teach us about cryptocurrency. I'm Dean Sevin Yeltekin. I am the Dean of Simon Business School at University of Rochester, and welcome to the Quick Takes. I'm going to highlight two recent events. The first one hits very close to home for me because I'm originally from Istanbul, Turkey. I grew up there. And the Turkish Lira has collapsed quite a bit over the last year. In sort of the first half of 2022, the Turkish Lira lost nearly a quarter of its value. And the inflation rate in the country has been rising. The official rate is somewhere in the 80%, but I was there during the summer, this past summer, and you can see actually the prices rising in real time. And according to some of the more unofficial measures, it's well over 100%. So about a year ago, one US dollar could buy about 6 Turkish liras. Today, it stands at 18 Turkish liras, 18.5 Turkish liras. So it has lost quite a bit of its value. Around the same time, we have seen a lot of crypto crashes. May 2022, we had 18 billion cryptocurrency called Terra USD imploded. Month after USD's collapse, total cryptocurrency market cap tumbled from 1.7 trillion, which is quite high, to 900 billion, so almost half. And January to August of the same year, Bitcoin lost up to 60% of its value and Ethereum lost up to 75% of its value. And digital coin Luna, because there are lots of different digital coins and currencies out there, has lost almost all of its value, standing at sort of pretty much at zero by May compared to what it was before just a few months ago, hovering around $80 to $100. So what is going on? And how are these two phenomenon or two events actually connected to one another? On the one hand, we have these cryptocurrencies. On the other hand, I started talking about the Turkish lira or a sovereign currency losing a lot of its value. Well, it's to do with the instability of these currencies, and it's to do with sort of the supply and demand with these currencies. If you want to avoid the fate of a lot of currencies, and especially a lot of the emerging and developing nations like Turkey, which has had a lot of currency fluctuations and sometimes implosions, you need to understand something about the history of that. So I'm going to go through 4 lessons that hopefully will stick in everybody's mind every time a new cryptocurrency or a new coin, stable or not, pops up into the market, that you have a sense of how to evaluate them. So let's think about currencies. What is really a currency? It's not about who issues it. It's not really about, you know, what it looks like, what denominations there is, whether it's paper, whether it's blue, whether it's in metal form. It's about what purpose it serves. And we have currencies that are viable that need to serve these values. So first of all, currency must be a good store of value, right? It means that when you actually have a little bit of liquidity in that currency, you don't want it to erode away very quickly. So in a country like Turkey or any other hyperinflation countries where inflation rate is high, this is not a great store of value. Why? Because by the end of the month, by the end of the year, the money you have in your checking account is able to purchase a lot less. And if you especially look at cryptocurrencies, given the fluctuation, you see that from a day-to-day fluctuations. Currency must be a viable medium of exchange, which means it needs to be acceptable and convertible. So you've got to have people buying into trading in that currency, right? A lot of people, the US dollar is a reserve currency. Lots of foreign transactions are made in US dollars, not just what happens in the United States. Oil prices are quoted in US dollars. Lots of borrowing happens outside of the United States, quoted in US dollars. So the US dollar is a very good medium of exchange. It's also a good store of value because its value doesn't fluctuate as much. And we don't see these sort of implosions happen. So what does it mean to be a good medium of exchange? We need to make sure that we're really solving a bit of a problem, right? The problem of double coincidence of wants. So the currency must offer something to the market. Why do we have currencies? Why don't I just, if I want to buy tennis shoes, and if I have a blanket that I've made at home, why don't I try to exchange these two things? Because that's a very inefficient way of doing exchanges. And that's a very difficult, the market with a double coincidence of wants happens. So what do? We use currency, and that currency's supply and demand need to be really tailored to the market, and that's what foreign sovereign governments really do. Central banks actually manage that supply. But in looking at the cryptocurrencies, there's really no barrier to entry. Lots of currencies are popping up on the system, and they try to maintain some sort of a supply side. When you look at something like Bitcoin, for example, the algorithm is written in such a way that the Bitcoin supply is going to be capped off, and you can't really mine that many Bitcoins. Well, it's costly, especially with energy prices being what they are today. But at the same time, if you look at the other currencies coming onto the market, there's a huge amount of variation, and there's really no barriers to entry. When you don't have a lot of barriers to entry, you're going to not have a very stable currency or currencies, because A, you don't get that critical mass of medium of exchange role. Not many people are using these things to be able to exchange them en masse. So there's no convertibility that you can rely on when you go to the market, when you go to try to do a transaction. And without those things, without those three fundamental values that a currency must offer, it's really difficult to convince that you're providing a service or you're providing a value to the market, why you should trade this one particular currency versus another. On the other hand, if you take the US dollar, that's going to be accepted pretty much everywhere you go, not just inside the United States, but outside of the United States. So what do a lot of these new currencies, cryptocurrencies, do to try to especially solve the problem of a good store of value, or to try to control that volatility? To control that volatility, they introduce some sort of stability. Try to introduce stable coins. What are stable coins? Stable coins are not very different from pegged currencies. What they're trying to do is basically maintain the supply and demand. So maintain the peg, maintain the value of that currency by moving the supply and demand. This is what peg currencies do. So if you take something like the Argentinian peso, if you take before the financial crisis, a lot of the East Asian economies' currencies were pegged to various foreign currencies, usually the US dollar, sometimes the euro, and before the euro, it was the Deutsche Mark, because these were stable currencies. So you peg your currency to another currency that is stable. And why do you do that? You do that because you want people to continue to invest in your country, continue to hold your currency, and you're basically backing it up by saying, look, if there's ever a need for me to jack up the demand in this currency because people want to get out of the currency and its value starts to depreciate, I will supply foreign reserves, something people want to hold, usually US dollars, in exchange for the currency that is losing its value. That's how pegs are maintained. Well, what do sovereign governments have the ability to do? A, they have big reserve accounts in convertible currency. Sometimes they deplete those, but they have big reserve accounts in convertible currency like the US dollar. They have ability to tax. They can actually raise some funds to be able to maintain that peg. But when you look at a lot of the cryptocurrencies that are especially stable coins or pegged cryptocurrencies, those entities do not have those sovereign abilities. They do not get to be able to guarantee that stability. They would need to provide a convertible currency like the US dollar all the time to be able to maintain the peg. So that's a really difficult thing to do. There's almost been in the history of pegged exchange rates, very, very few pegged exchange rates that have gone into a floating system or have maintained the peg in an efficient and costless fashion, relatively costless fashion. Almost always, whether we're talking about the Black Wednesday of the European exchange system, when that collapsed and Britain decided not to join the European currency exchange mechanism. When you're talking about the Asian crisis in 1997, when you're talking about the Argentinian peso collapsing many times, the Turkish currency crisis in the 90s, as well as in the early 2000s, and we're experiencing one right now, no matter what we call it. These things happen all the time because it is actually very difficult to maintain a peg in those unstable areas. So the bottom line is that we're looking at a series of currencies that are trying to attract buyers and traders by trying to put a stability onto the currency. And that's a very difficult thing to do, because when you buy, for example, if you were to buy a certain type of currency in the United States, you know, $1 million in Tether, can you actually at any point in time decide to be able to convert it into US dollars if you have $1 million in Tether? The answer is no. The convertibility is not there. And without the convertibility not being there, you're going to have a lot of people being very cautious about investing in that currency. And when the currency starts to lose value, a lot of people are going to want to get out of it or short it. And that's going to make the value of that currency start to decline, or the coin to start to decline even more. And the entity behind it needs to be able to maintain the peg or maintain the value. Well, that's very, very difficult to do, because for every tether, then you have to supply something else, something that is acceptable to the other side of the traders. And if sovereign governments cannot do that very effectively, it is very difficult for cryptocurrency entities to be able to do that. And that's why we're seeing a lot of fluctuations, a lot of contagion. We saw the same kind of contagion happen during the Asian crisis in 1997. Once some of the, for example, the Thai baht or the Indonesian currency started to go down, then it sort of started to spread. It spread all the way across actually half of the globe to some of the other currencies within, for example, the Russian ruble and so on. So this is a very, very difficult domain. There's a lot of history of money. We've been studying money as economists for a very long time. The history of money is almost as old as the history of mankind. And we've had to think through all of these problems, things like convertibility, scarcity, store of value, medium of exchange. And you need to really use these kinds of sort of basic fundamentals to evaluate whether anything coming online, whether any kind of these assets coming online is viable, is here for the long run. Can you make money by speculating on them, by trading them at and lucking out, buying low and selling high? Absolutely you can, but the tremendous amount of risk that you're taking and sort of the stories or the narratives around it being a stable currency and being sort of backed by another currency are really some things that you should look into very, very deeply, because this is not a very easy domain. This is not a very easy thing to maintain. And most of them don't have the level of convertibility and stability that they claim to have. So with that, I'm going to sort of leave you with the bottom line, which is that, yes, right now times are bleak for crypto, which doesn't come as a surprise to many of us who have studied sort of the history of money in cryptocurrencies, because there are just some fundamental aspects of cryptocurrencies that are missing. It's difficult enough for sovereign countries that can issue sovereign currency, maintain capital controls, maintain control over banking systems and transactions, and have large foreign reserves to even maintain a currency stably. For any kind of single entity, private entity, to do that in a very efficient and relatively good fashion is very questionable at this point. And without any kind of government pegging, government backing, it's very difficult to do that. So the crypto investors, enthusiasts, and you can count me amongst them, I certainly like to learn a lot about this market, really need to measure whatever is coming online against these particular fundamentals. And these fundamentals, they're very easy to check. They're very easy to find out exactly how the stability is being maintained. What is the convertibility rules? Is it a good store of value? Is it a good medium of exchange? How well is it accepted? So Can we make money off of this market? Absolutely, if you can take on the risk. But it is an incredibly risky market, and the stability is simply not there. So at that, I'll stop and open it up for questions. So I would like you to please submit your questions through the Q&A rather than the chat system. So please submit your questions through Q&A. And while those are being submitted, I'm going to go to some questions that have been submitted ahead of time. Okay. What is the role of interest rates in currency valuation as one of the cursor? Well, interest rates, and we have a parity between currencies and value of a currency and interest rates. It's not a parity that holds every moment in time, but it just is a very fundamental kind of concept. When investors are looking for the best kind of assets to put their money on, right? These are savers who want to sort of chase high returns. A country or an asset that actually delivers a higher interest rate is going to be attractive. So for example, if I want to invest in the US bond market as a European, because the bond market is both now giving higher interest rates with the Fed increasing the interest rates, at the same time, the US dollar is a relatively stable currency and US bond market is risk-free. What do I want to do? I want to convert my euros to the US dollar. The more people do that, because it's giving high interest rates, high returns, the more you're going to have a demand for that currency. And as that demand for the currency rises, the value of the currency rises as well. So there is a parity between interest rates and currency value as well. Some people, this next question is, had hoped that cryptocurrency would universalize and democratize money. Does lack of jurisdictional backing ultimately reduce trust in a cryptocurrency? Well, that's the whole point. We weren't supposed to give jurisdictional authority. The way when you look at sort of how Bitcoin at least was sort of founded is that if it's going to be really democratic, meaning we don't need a government sovereign entity to be able to mint and supply this currency, that we can do this as completely private agents, right? That's where the mining came from. Then we don't really need. So the jurisdictional thing is, yes, can we actually exchange in it? But beyond that, it was supposed to actually replace trust. That's what paper money does. It replaces trust. It's you get to hold that money and it's yours, right? It's not an IOU from somebody else, it's yours. And as long as it's convertible and acceptable, you can make transactions on it. The whole point behind the Bitcoin was that we didn't need that government entity. And the blockchain is what replicated the trust, because the blockchain was really difficult to manipulate. We didn't really need trust. I didn't know who I was exchanging money with. I didn't need to actually know the counterparty. But now we're seeing that it's not that easy to create a currency. It's not that easy to democratize a currency. If anything we've learned from the Bitcoin experiment is that we've had anonymous and very, very consolidated large entities controlling most of the mining. And the mining is incredibly expensive because of the energy requirements. So in which way are we really democratizing currency? Not in any way that we can see. And do you really want to trade off that maybe perhaps a little bit of a slightly untrustworthy sovereign government who you might have questions about, but at least you know who it is, versus kind of 2, 3, 4 entities or a handful of entities that you have no idea who does the mining and who controls a lot of that server power. So the democratization has not happened. And this no barrier to entry, which is trying to do the democratization, also means that there's really no profits to be made, because with no barriers to entry, the price is going to just simply go down to a level where there's no profits to be made. So let me go to some of the questions on the chat here. You mentioned 2/3 roles of a currency, medium of exchange, store of value. Do you see a unit of account being developing in cryptocurrencies? Yes, I mean, we can, unit of account, we can certainly develop it, but without us, none of these roles of currency are independent of one another, okay? You cannot be a unit of account, meaning measuring things, right, in those units, if you're also not a medium of exchange. So I don't know how to convert certain types of goods and services into that unit of account, or you're not a good store of value. So these are interdependent. And I think you need to be a good store of value and a good medium of exchange before anybody's going to even accept you as a unit of account. Again, small entities, small groups, you know, we could be a group of friends exchanging tennis shoes as currency. But to be able to get that scale, to be able to get that widely accepted currency, we need to get to scale, and really massive scale. We need to be able to do transactions quickly, relatively costlessly. We need to be able to do them in a variety of places, and we need to be able to securely own that currency. And a lot of the things that we see with the cryptocurrencies is also the ownership structure. What do you really own when you own just a digital asset? Cleveland White, given the role of USD as a bellwether of economic conditions, do you think cryptocurrency have the ability to overcome Triffin's paradox? Honestly, I don't know what Triffin's paradox is, so you're going to have to explain that to me sometime, but I'll tell you this. Do we really think that, given that the US dollar is the bellwether of economic conditions? Yes and no. I mean, US dollar is certainly the reserve currency. We certainly do sort of look at the global conditions, or at least the US conditions. It is a safe asset. People tend to go towards a safe asset when their own countries are having some difficulties, whether that's coming from hyperinflation, war zones, or government fluctuations. But for the cryptocurrencies, again, without the scale, without the convertibility, and without and with that kind of volatility, it's going to be very difficult for them to replace most of the stable sovereign currencies that we have. Sandy Putty asks, do you think stable coins such as the USD coin offered by Circle have better fundamentals and sustainability in the future? I don't think so. I do think that I have not yet seen any of these currencies to offer very, very, substantial stability. Because again, you have to ask yourself, what are the control mechanisms? What can the entity that is issuing this coin able to guarantee, and able to guarantee sort of sustainably, right? When even you think about a sovereign government with large amount of reserves, right, trying to defend its currency. What do? I mean, we saw this just in the Bank of England did this after the government announced these widespread tax cuts, and then they did a U-turn, of course. But what happened after the tax cuts were announced? The British pound started losing huge amounts of value. Bank of England swooped in and intervened in the foreign exchange market. What do? They basically raised the demand for the British pound by buying British pound in the open, in the foreign exchange market, and in exchange for it supplying something. Well, what are you going to supply? Typically, either you're supplying US dollars or you're supplying euros to be able to bring the value of the British pound back up in the market. Well, how long can you actually do that? Well, there's a cost to doing that period because you're losing reserves and you're intervening and you're distorting the market. But beyond that, you can only do that as long as you have foreign reserves. Now, the Bank of England may have a lot of foreign reserves, may be able to issue a lot of repos and so on and so forth. But think about a country like Turkey that doesn't have as much of a foreign reserves, and that its sort of government sustainability and finances are even more questionable than a country like Great Britain. So when you think about those issues, it's very difficult for a private single entity to be able to maintain, because they just don't have the levers. They just don't have the backing. They just don't have the reserves. And even if they did, the cost at some point exceeds the cost of maintaining the peg stability exceeds just being able to just get out of the market and let it devalue. And where is that tipping point? You need to find that tipping point for not just for sovereign currencies, but also for the cryptocurrencies as well. If a currency is weak, how much weakness will the market tolerate? Well, I mean, that's exactly, not only just how much weakness will the market tolerate, how much weakness will any of us tolerate, right? In terms of sort of, if you're the sovereign government if you're the Bank of England trying to prop up the British pound, How much of the reserves, foreign reserves, are you willing to give up? And how much intervention and distortion are you willing to accept to be able to maintain the British pound? And it's the same way for these private entities that have even less resources, right? It's the market is watching. Why do we see shorting happening? Not just in cryptocurrencies, but also in sovereign currencies. It's because you realize that at some point, the government even is not going to maintain that peg because it's just too costly. How did George Soros make a lot of money in the 90s? Because it realized that the UK just didn't want to stay in that European exchange rate mechanism. And that if anybody was going to float and get out of the European exchange mechanism, it was going to be probably, the UK. And that's exactly what they did. They didn't want the British pound tied to the euro. At those days, it was the European exchange rate mechanism. And they were the first ones to float it. And once it floated, the British pound lost value. It was very easy to deliver on those short positions. And then you could make definitely a huge profit on the margin. So it really depends on what positions the markets are taking. But at some point, if you don't have that bulk of reserve or the political will or the leadership will to maintain that peg, that's when the market realizes you're going to get out of it. The costs are there and the transaction costs are huge. Another question is, what if any is the fundamental source of a crypto like Bitcoin that is not a stable coin? How would you even start to think about valuing it? Absolutely. I mean, that's a very fundamental question. How do I even think about valuing something that's supposed to be a medium of exchange or an asset? And I don't know what exactly is if it's not stable, how do I even think about what it's fundamental? Most of the time, even with stable things, relatively stable things, like when we think about what is the fundamental value of a US dollar, that's not an easy question to answer. What is the fundamental value? Well, we think about sort of the economics behind it, what's happening to the US interest rates, what's happening to the US growth prospects, what's happening to exports and imports, what's happening globally. And we try to gauge what that fundamental value should be. Without any of those sort of conditions to be able to benchmark against, you're absolutely right. I don't even know how to begin to value. So I look at these fluctuations, I kind of watch it, but it's very difficult to gauge where exactly. So all of these speculations we get by 2030, Bitcoin should be at 30,000 or 2,000. These are really, I mean, you might as well, as far as I'm concerned, throw a dart at the wall because they're just completely speculative. They're not based on any kind of fundamentals. Why is the Turkish lira falling so significantly? Oh, gosh. The answer to that is unfortunately both very, very transparent and very easy because the Turkish government is, the growth has slowed down and the Turkish government is spending a lot of money both on infrastructure as well as on other things, and not to mention various sort of, entanglements in the region that it's been on terms of defense spending. What would you do if you're spending a lot of money and you're racking up a huge amount of deficits and debt as a government? Well, you should make sure that your monetary policy isn't so lax. You should actually start to increase interest rates. But the Turkish government has been anti-interest rates. They have been actually cutting interest rates, doing exactly the opposite of what your Econ 101 book should tell you. So huge amounts of money supply and very low interest rates that brings both inflation as well as instability into the currency. Not to mention that the other shocks that's hitting the Turkish economy, just like any other economy, which is high energy prices, high food prices, and so on. So where does that leave us? Should the US, somebody has asked, introduce a digital USD? So we're thinking about maybe the Federal Reserve actually introducing a digital USD. What would be the role of such a USD? What are we trying to, fundamentally, you always want to ask the question as an economist or anybody who's trying to bring a new product to the market, what problem is it solving? What friction is it getting rid of? That's where its value comes from. What intermediation is it doing, perhaps more cheaply, more effectively, that we cannot do with any other currency. With a digital USD, right, then do I and you as kind of just private citizens get to own accounts at the Federal Reserve? How does that alter? How does the Federal Reserve do monetary policy? How does that alter the role of the banking system as an intermediary? How does that alter some of the commercial banking? We're going to have to ask those questions. And I think that's being discussed both, especially in Europe and in other places, much less so, I would say, in the United States. That is a viable option, but we need to answer the fundamental question I started with. What problem are we trying to solve? What are we trying to fix? So thank you. I'm at time. Thank you for all of your participation. These are really interesting times and turbulent times, but that's what makes for a great discussion. Have a wonderful rest of your day.